Good afternoon, and thank you for joining us for our June webinar episode, an episode we're excited to dive deeper into the investment philosophy and approach of Kaplan Funds Management, and this comes on the back of Doug Hugh presenting at the recent masterclass on investing for income. Kaplan and Doug have been known to us and part of our stable under the All-Star series of funds for 11 years now. So welcome, Doug.
Thank you, Julian.
My name's Julian Pitton today. Delighted to be here with Doug, Portfolio Manager and Director of Kaplan Funds Management. Before we get underway, I just need to do a little housekeeping. Information in today's webinar is general in nature and should not be construed as personal advice. CPD points will be provided to those who see out the duration of the update. This webinar is being recorded and will be made available to those who weren't able to make this time. If you have any questions at all as we go through, please ask them in the question asking area. I certainly know we had a few just a few weeks ago for the more generic investing for income session. So let's make use of this time and Doug's time here and get all your questions answered. Doug, I guess to frame up the conversation and the need for income strategies with advisors and in client portfolios, we're entering a new era, really, of investor demand for income with the demographics, just as the complexities of the market are set to change. We've seen bond yields rising for the first time in 30 years, with a likely impact on what's traditionally been known as safe asset valuations. And at the other end, we've got quantitative easing being withdrawn, which is really going to remove the support for those more traditionally risky type assets. So navigating the dynamic will be critical in offering investors the downside protection that income investors generally want, but also while delivering on income needs. You guys have been doing it for nearly 20 years, or just on 20 years. So I'll just duck through the first slide myself and then hand over to you to let us know the thoughts on all those aspects. These are the items we go through. We'll make these slides available at the conclusion of the presentation as well, the webinar. Just quickly, in relation to Ventura, really, I guess we are seeking to understand the changing needs of advisors and investors and really assess our ability to add value through partnering with specialist providers for the benefit of our supporting advice firms and the investors we serve. This model has allowed us to accumulate over $1 billion now in end investor investments. So thank you very much for the trust and support that you have provided in recommending our solutions to your clients. As many of you would be aware, we've recently been through a rebranding exercise with Ventura FM, and as such felt it really appropriate to bring this KFM capability, what was traditionally known as the All-Star KFM Income Fund, more into the go-forward brand stable of Ventura FM. So while that has not taken place just yet, it's likely to in the very near future, and happy to answer any questions on that, but we'll be getting a communication out to all our supporting advisors before that obviously occurs. So Doug, over to you. It is a complex environment. Income needs are on the rise. Maybe if we can take us through a little bit about KFM and the philosophies at a high level to start.
Okay. Thanks, Julian, and good afternoon to everyone. Kaplan Funds Management, as Julian mentioned, started about 20 years ago. Sam Kaplan created the funds management business. It's focused on income generation with professional risk management, and we seek to deliver consistent returns with low volatility. So naturally, our client base, which is about 1.1 billion, is basically charities and foundations, some superannuation funds, and also high net worth individuals. The team is highly experienced. We operate with a small team. Our board of directors, on the next slide, you can see here, we have Sam Kaplan, Chris Corrigan, which you're probably familiar with, Tony Berg, who used to be the MD of Macquarie Bank, Gillis Krieger, who actually started Ord Minnett in Australia and was a board director of Westpac. Got Sam, myself on the executive, and Derek helping us out with research. So a small team. We've been together. I've been there for 16 years, and we really have kept this as a boutique wholesale business. And the link with Ventura is basically to provide a retail channel for our business. The investment philosophy, as I mentioned, is long only, absolute return. We're basically trying to achieve very good risk-adjusted returns, and that requires, from our point of view, an assessment of the environment and the investment risk we're facing, and also, the appropriate portfolio construction. And we've been through, with this fund, quite an unusual period, and so has everyone else. We've been through the pre-GFC, the post-GFC. We've been to a period of unprecedented monetary liquidity, quantitative easing, and now we're entering into a period of quantitative tapering and shrinking, and history in our lifetime. On the investment process, as I mentioned, the macro analysis is very important. We don't change our view frequently. It's more strategic, and we've been defensive with the view of the market tightening in terms of normalization of interest rates and balance sheet shrinkage from central banks. And we took this view probably about 18 months ago, and we've been, I guess, a bit early, but we're sticking with it. And as you'll see later, where it impacts the portfolio is in terms of our duration risk, to try to minimize exposure to higher interest rates, and also the equity risk has been minimized. And that's under the buy and write strategy. So those two components have reflected our defensive stance. Security selection for us is always very important. We're basically looking for quality companies with very little credit risk. And in terms of buy and writes, as you know, buy and writes only provide a minimum amount of downside protection, so security selection is important. And volatility. We're managing portfolios to achieve lower volatility, so we tend to avoid anything that is speculative. For example, if we're looking at credit risk, if we're not happy with the equity risk and it's not investment grade, we won't participate. So what you'll see is our hybrid portfolio, corporate bond portfolio, is basically 97% investment grade issuance. There's a very small part of the portfolio which isn't rated, and that's because the corporates like Cube and Ramsey have chose not to be rated.
Doug, could we just spend maybe a minute or two on the buy and write strategy, just to make sure all those on the phone are familiar with that strategy and how it does protect the downside?
Yeah. I'll just go to the next slide. There's a bit on that. The buy and write strategy, basically, look, when we invest in equities, we're investing to harvest dividends, and therefore we want to reduce the capital risk of doing that. We've been operating a buy and write strategy for our funds for 20 years, and what we do is we buy shares and we just write a covered call option against those shares. So effectively, we're forward selling the share price. We're not overselling. so there's no speculative risk. But what we're doing is basically capping the upside for downside protection. And the parameters that we look to achieve just very generally are 5% downside protection, a 10% standstill return, and a 15% exercise return. So if things pan out as we expect with buying rights, we should achieve between 5 and 15% returns from that part of the portfolio. Now, the risk with the buying rights strategy and what we have experienced in the last 12 months is what happens if the share price falls quite dramatically. Take, for example, Telstra. We've had a holding in Telstra. The stock price has dropped 27% over 12 months. As I mentioned, when we enter into a buying right, we're looking for about 5% downside protection. Telstra ate through that quite early, and we were impacted. The other point to make is that when we're managing income funds, you don't want to have everything in one basket. So we create diversity of risk between equities, credit. We've got regulatory risk with utilities, and we've got rental leasing risk with property trusts. So we put all those together, and we manage the exposures to try to achieve a good risk-adjusted return. We're not going to, we'll come undone, for example, like Telstra, but it's not going to ruin the whole portfolio because of the diversity.
And just quickly to clarify for those on the phone, the downside protection that Doug mentioned around what they look for about 5% downside protection is the initial income you receive from writing those.
Yeah, so writing means selling. So we're selling call options into the market and receiving a premium for that.
And you get that up front?
We get that up front, and that provides us with a lower cost entry price against the shareholding. Yeah. Now, I'm being very simplistic. When we hold, let's say, the banks, Telstra, BHP under a buying right, we might have 10 to 20 option series against those individual holdings. So we stagger the strike prices, we stagger the maturities, and that's all about risk management. We find that doing that allows us to reassess the outlook every 3 months for the holdings.
And with volatility entering the market again over the last quarter, there's been some more opportunity to have a look at that space? Or?
Yeah, the returns have improved, but our assessment of the financial environment is that we don't want to introduce any more equity risk into this portfolio.
Yeah.
We're now seeing the impact of higher interest rates and central bank tightening starting to affect emerging markets. That's rolling through at the moment, and it's also the U.S. deficit financing pressure has lifted our bank bill rate. Now that has effects on the banks here in terms of their funding costs. It also, there's a lot of corporates that borrow off the bank bill rate, so their cost of funds have gone up. With our portfolio, our view was that we always wanted to benefit from higher interest rates, and the lift in the bank bill rate lifts the reference rate for hybrid distributions. So what we've seen this quarter is about a 5% increase in distribution from hybrids, simply because the bill rate has gone up. And that's one of the benefits of hybrids. And what we're seeing now is this month, the hybrids have jumped about 0.5% in the first couple of weeks. And that's because a few of the funding pressure issues from new issuance have passed, with the Macquarie issue now digested. And the investors are now focusing on that higher distribution rate for hybrids. With with the other securities, utilities, as I mentioned, regulatory risk. What we're seeing now is government legislation rolling through that is acting really against utility companies stretching returns on assets. It's also limiting regulated asset growth. So a few companies out there are looking to increase their unregulated asset base to drive income. And it's a new environment. We're quite defensive about it. Our utility exposure was running at about 12% a year ago. It's now down to 3%. With property trusts, we've basically avoided the retail end, and we're focused on office, regional neighborhood shopping centers, and industrial. And there's been a bit of takeover activity there. One of our holdings, IOF, has received a takeover bid from Blackstone at the end of last month, and that represents about 2.5% of the portfolio. So our property trust weighting will come down as well. So effectively, what I'm saying is that we're trying to de-risk the portfolio, and we might, in 12 months' time, we might very well be holding more cash and even term deposits. We're now achieving about 2.6% in term deposits, which is a reflection of the elevated bank bill rate as well. So, we've got capacity to move to that very defensive side of the asset spectrum if we wish, and we'll judge that as we progress through this year. The next slide here basically tells you the asset allocation. We're at our maximum of 60% in interest rate securities. Now that's corporate bonds and hybrids. Our exposure there to financials, I mean the banks, is about half of that weighting. Half of that 60% is exposed to bank hybrids. The other half is exposed to corporates and insurance companies such as IAG. We're overweight interest rate securities as a defensive stance. As I mentioned with utilities, we're underweight. There's some regulatory risk creeping through. Property trusts, we're overweight, and we're pleased we're receiving takeover bids. In the last 12 months, we had a very big position in the Asia Pacific data center, which was a property trust that housed data centers in Sydney and Melbourne and Brisbane. We've exited that. We're expecting to exit the IOF position, and we'll see, property trust weightings come down a bit. There's not the same anxiety in property trusts that was there in the pre-GFC period, where you had very high leverage. You had a bit of financial engineering. That has passed through. The property trusts are now fairly conservative, and they do provide income, hedged income against inflation, and a lot of increases flowing through. And if they pay in corporate interests, such about 11%, we don't really see that increasing or decreasing too much. We're at the low end of our exposure on bond rates. Where we will manage the risk is when the June options expire this month, we'll be rewriting options into December and March next year, and we'll probably be pulling down the strike prices to increase the premium, which increases the downside protection. But we still want to harvest the dividends coming up in September. And this chart here is basically a schematic of our investment environment with all the different asset classes we invest in. On the horizontal axis, we've got cash term deposits, corporate bonds, bank subnotes, capital notes, property trust, utilities, banks, and Telstra right at the end, which we see as the high risk. The banks are yielding 8 to 9%. Telstra is yielding 11%. We actually don't think that's sustainable. You do need to if you want to harvest those dividends, you need some capital protection. And that's what we do through the buying rights. So the idea is to provide a premium yield without taking on too much risk. And we move up and down that spectrum to try to control that and deliver a good risk return outcome. The history of the asset allocation of the fund has been quite active. This goes back to March 07, pre-GFC. The fund held quite a lot of cash. Going into GFC, we had about 50% in cash. The stock market, as you're aware, collapsed quite violently. We increased the buying right component, which was basically near zero, to the maximum of 50% on delta adjusted basis of 25, which we're allowed to take for this fund. What was interesting is when we moved into the equity market, it had already fallen by about 25–30%, and we felt that we can step in and buy the banks, and Telstra and BHP, through the option market, delivering another 10 to 15% downside protection, because volatility was high, premiums were high, and we felt, well, that's an acceptable risk to undertake for this fund. If the market fell another 10 to 15, we'd still break even. So we elevated that to its maximum, and then, as you can see there, that we've tapered that down gradually over the years, and we're down to about 11%. On the opposite side of the spectrum, we've lifted the hybrid portfolio to its maximum of 60%. Property trusts and utilities have been, roughly 15, nearly up to 20, and you can see the dip there in utilities about a year ago, where we exited out of Duet. That was a big position we had in the fund, and it was sold under takeover. As I mentioned, with Property Trust, we sold Asia Pacific Data Center under takeover. The other impact you should note for this fund is when we realize capital gains like that, which were substantial, we actually pay that out in the quarterly distributions. And we've got a slide on that a bit later showing the impact. If we look at the last 12-month gross returns for the fund, you can see here that the interest rate securities delivered 4.6, utilities 9.2, and we did have the benefit of the Duet takeover in there. Property Trust 12.5. Property Trust has been a very good performer. As I mentioned, also takeover activity helped us there. Buying rights, we achieved a minus 4.5% return, which was disappointing. That was really the result of a 27% decline in Telstra, nearly a 10% decline in the major banks, partly offset by about a 22% increase in BHP. So we've had a major sell-off in equities. It impacted the portfolio by reducing the return by 0.46%. We had some protection from options, and the fund delivered all up 5.36, with a running yield of about 5.8%. So the last 12 months, we think this type of return of about 5 to 6 is something that we think is a bit more consistent with the environment we're in. Previous returns, as you can see here, over the last 5 years, 7 years, have been up around 6.7 to 7.3. We don't expect to achieve that going forward in this environment. With the last 12 months here, you can see this is net of fees. The return was 3.44, and the fund actually paid out some performance fees because our returns were quite high up to the December quarter. The income in this schedule here of 7.5% reflects about 4% of realized capital gains that have been paid out as well, which partly offsets the unrealized growth of -4. But the end result was after fees about 3.44. and the history of the fund's return has been excellent against its benchmark, against the hybrid and corporate bond index, and against the ASX. And you can see on the bottom row, the fund's volatility has been consistently around about 30 to 40% of the ASX volatility. So a higher return, lower volatility, and consistent income. This is another way to illustrate the effects of portfolio management when looking at various income securities. So on the right-hand side here, we've got the REIT index, which produced a return of 11.5%. This is from January 2009 to March 2018, so about 9-10 years. The volatility there was around about 14.2%, quite high over that period. The ASX accumulation returned 10.3, again with fairly high volatility of around 12%. The utilities index, similar. The buy and ride index, a little bit better in terms of risk and volatility. 12 and volatility of 9. And the hybrid index, 8.4 and volatility about 5.5%. We operate in all those sub-indices, and the fund over that same period achieved a gross return of 10.1 with a volatility measured near 4. So when we take the return divided by risk, which is the pink dots, you can see that the managed fund was able to add value in terms of the risk-adjusted return, and that's what we try to achieve. So in summing up, we've got a diverse source of income for this fund. We manage the asset allocation. The fund's running yield is around about 5.5 to 6%. It delivers low to moderate volatility, and we should see some income growth. Now, that income growth is, as I mentioned, coming from higher interest rates. As the rates go up, the hybrid distributions increase. We're also getting some income growth from property trusts. The income growth used to be reasonable for the utilities. It's now compressed to steady almost because of the regulatory pressures. And income growth from equities, in our opinion, is becoming harder. We don't see much dividend growth going forward. In fact, there could be cuts to the banks and Telstra. This fund operates in the listed market, so it's fully transparent and has, very good liquidity. The equities are all in the top leaders. The option market's liquid. The hybrid market's reasonably liquid now. 10 years ago, it was a lot smaller. It's now capitalized about 45 billion, and the turnover is lifted to about 40 million a month, which is quite reasonable. So that concludes my presentation on this fund, and happy to answer any questions.
That's it, yes. As you type in your questions, thanks very much, Doug. I would note also that the very strong peer performance in the Morningstar multi-strategy income category, a category where this fund is placed, doing very well to peers over all time periods. It is a very complex and dynamic market. As mentioned, the bond yield, 30-year bond yield rise. Doug, you mentioned that no one really investing here in the room or on the phone would have experienced that, really. And also the withdrawal of stimulus from the QE period. So it is very complex. And dealing in a wide range of income-related instruments and being able to increase and reduce exposures as per the current environment, we strongly believe in. We'll just wait a few more moments for any questions. One coming through on how to access. We do, under the new brand Ventura FM, the website is venturafm.com.au. You can find the fund there. It does have its own PDS with a $20,000 minimum per investor, or available through most of your platforms. Reach out to us though if you have any trouble finding it or need access somewhere else. As mentioned, you'll be seeing a name change come through from the All-Star KFM Income Fund to the Ventura KFM Income Fund. We'll be notifying you first about the process around that, and you can expect something in the next few days on that. Doug, thank you very much for your time today, and following on from the more general sort of investing for income presentation that was delivered a few weeks ago that was very well attended. We'll get a copy of this out to those on the line. And if there's nothing further, we shall leave it there unless you have any parting gifts of... We will leave it there. Thank you very much for the time today, and we'll come back to you with all the follow-up material shortly. Thank you.